Roth 401k versus Roth IRA. Hi, this is Sean Mullaney. I'm a financial planner. Let's get started. Roth 401ks, great account for retirement savings. These are workplace 401k accounts that have the Roth feature, right? Which means no tax deduction on the way in, but tax-free growth and tax-free on the way out. There's a current limit on them in terms of annual contributions. The limit is $20,500 for those under age 50, and then $27,000 for those age 50 and above. These are really great workplace retirement accounts. However, there is an opportunity cost anytime you make a Roth 401k contribution. Here's what happens. That $20,500 limitation I referenced, $27,000 if you're age 50 or above, that is shared between a Roth 401k and a traditional 401k. That has the consequence of saying, okay, every dollar you put into the Roth 401k is a dollar you cannot put into your traditional 401k. What's the problem? Well, the problem is every dollar that goes into that traditional 401k gets a tax deduction, right? So the Roth 401k, as great as it is, has an opportunity cost. And that opportunity cost is a tax deduction while you're working, because if you put $27,000, say you're over age 50, into a Roth 401k, you can put zero into the traditional 401k. So that is something to keep in mind about the Roth 401k. There is an opportunity cost there. What about Roth IRAs? These are personal accounts. They have a limit of a $6,000 annual contribution if you're under age 50, $7,000 if you're age 50 or above. These accounts are interesting in that for many out there, not everybody, but for many, they will not be able to deduct a contribution to a traditional IRA. So the choice is either make a non-deductible traditional IRA contribution or make a Roth IRA contribution. Traditional retirement account contributions, if you can't deduct them, often don't make a lot of sense because there's no deduction on the way in and it's fully taxable on the way out. Now, there's the backdoor Roth strategy I'm sure many of you heard about where that could be a part of it. But if we're just talking about an after-tax contribution by itself, that's not very advantageous if you can't deduct it, right? So in the case of a Roth IRA contribution, it may be that you're not foregoing a tax deduction because you wouldn't have qualified for one anyway. If that's true, it may very well be that a Roth IRA contribution is going to be a better route than a Roth 401k contribution. The optimal strategy might be, and you need to assess your own circumstances, but it might be to, while you're working, deduct every last penny you can into the traditional 401k, and then on the side do a $6,000 or $7,000 annual Roth IRA contribution or annual backdoor Roth. I've put in the show notes a blog post detailing the difference between a Roth 401k and a Roth IRA. Please like, share, and subscribe. Thank you so very much for watching.